Welcome back to this Moneycontrol live stream. You're watching Closing Bell with me, Nandita Khemka. Well, it was a good day of trade given the fact that 22,000 is back on the screen, and you have the Fed to thank. You have to thank Fed for that, given the fact that they haven't really disappointed the street. They have reiterated their guidance to cut rates. 3 times this year, 25 basis point each, so 75 basis point cut is what they have guided for, and the markets have cheered that because, of course, it has removed some sort of uncertainty that was lingering over the rate cut trajectory of the Fed. But of course, global markets also in fine fettle, and so are our markets. As I mentioned, 22,000 back on the charts. If you look at the mid and small cap indices, the rebound was stronger there. Both the mid and small cap indices rallied by over 2% a piece. Also, the volatility index has come off 7%. In fact, it is now below that 13 level. And if you look at the sectoral movers, all of them were in the green. In terms of the leaders, sectoral leaders, you have metals, PSU banks, as well as realty. Nifty Bank as well came very close to that, I think 47,000 mark, but kind of 46,700. I'm sorry, yeah, 47,000 mark, but then that mark really eluded us. Let's see whether we can, continue with this momentum tomorrow as well and reclaim that 47,000 mark, which, by the way, technical analysts are pointing out is a crucial, level to watch out for on the Nifty Bank Index. In terms of movers, OMCs. A few days of sell-off came in. We saw BPCL staging a good rebound over the last two sessions, and today as well, BPCL among the top Nifty gainers. So was NTPC Power Grid. So PSUs have staged a very good comeback, so to say. Coal India as well. IndusInd Bank was the other one. On the losing end, losers are few and far between today. Airtel, HDFC Life, ONGC, Maruti, and ICICI Bank. So some of the private banking names also under a bit of pressure. Without any delay, let me bring on board our guest for today. Joining me is Nirav Karkera of Fisdom Research. Great to have you as always, Nirav. What are you making of today's up move? Should we call it a dead cat bounce on the back of some bit of euphoria over the Fed's rate cut indication, or would you say that this time this rebound is a bit different and there's more legs to it, and perhaps it will sustain?
So, Nandita, always a pleasure chatting. And, I would say this is much more than simply a dead cat bounce. This is slightly more structural in nature. Of course, the correction that we saw, or rather the carnage over the past couple of days, depending on how deep were you invested, following that, we believe, there was still a lot of uncertainty that was lingering around the FOMC meet. And to be honest, there were some expectations that the rate cut would not be in alignment, and there were risks to the outlook that was expected. However, the FOMC delivered a pleasant surprise with something that is not exactly, but at least close to a dovish stance, and that has been very well, captured on the streets, not just in the equity markets, but also reflected across the fixed income markets globally as well. So there is more reason to believe that this could be much more of a structural recovery from here on, and we are optimistic that going ahead, any such intermittent, corrections or dips will be viewed as a buying opportunity, like we saw over the past couple of days, and which led up to today.
Right. The street was fairly stressed about the stress tests, when it comes to the mid and small cap funds, right? We saw the results. What are your thoughts? Do you think the kind of rebound we've seen in the mid and small cap indices, do you think that's also sustainable? Do you think there's a fair bit of rotation now happening from, the small and illiquid stocks into more quality names? Is that what's happening now?
So, a couple of things. At the outset, I'd like to state that the outcomes of the liquidity stress test was largely favorable and in line with what most of us expected either way. So, the mutual funds have been doing a fantastic job at managing their liquidity positions, right? So, that's there. Apart from that, we believe that the current correction also witnessed a lot of a lot of smart buying happening at much more corrected values and valuations right now. It is we expect going ahead, mutual funds will continue to maintain very good liquidity. So broadly and by large, the liquidity situation was already in control, but the expectation is that going ahead, now that the disclosures are more transparent, etc., there will be a very conscious approach to maintain exposures towards more liquid stocks, if at all possible, right? So we believe that during this entire cycle, there could have been potential rotation out of typical low float stocks, or slightly illiquid sort of stocks, wherein there could have been some rebalancing and reallocation into more liquid counters. If you see, even the recovery has been in favor of slightly more liquid counters. Not that there is any causation, but there is some sort of soft correlation between the stocks that really dipped during the past couple of sessions, and the other set of stocks that managed to post a smart recovery between yesterday and today.
All right, then let's break it down to certain sectors and stocks that are on my list this afternoon. Starting with OMCs, there was a fuel price cut of 2 rupees. That was much. I think that was a bit lower than what the expectations were, right? And crude prices have been surging off late. But today we've seen a good rebound, in the OMC basket. But how much of a squeeze would it be on the margins? Do you think, here on there would be some pressure on financials because of the double whammy of rising crude prices and the retail fuel retail price cut? Do you think that would come as a bit of a dampener for margins, especially for HPCL, which has a higher share of marketing margins?
So, of course, this is expected to have an impact on the margin. I feel the broader question is the quantum of such impact, right? So, considering that crude oil prices have been indeed surging, and while the jury is still out on how sustainable is this uptick in crude oil prices, I feel on the other hand, the cut in fuel prices, that itself is not very significant, right? So, considering both the counters and a slightly relatively smaller price cut, versus what was expected in terms of retail fuels, and the oil prices surging way past expectations, and most of it already being priced in. I feel going forward, everything, all sort of margin compression that one could have expected has already been priced in, right? So, from a risk reward standpoint, we are at a very good position right now. Of course, there are downside risks, but at the same time, considering where we are, and at least in terms of crude oil prices, the potential for an upside surprise is, or the probability of such an upside surprise is slightly higher at this juncture. So yes, there will be margin compression, but will it sustain? Probably for a couple of quarters. Has it already been priced in? Largely, yes. Going ahead, is the OMC segment open to positive developments and positive surprises? Yes, I believe any surprise on the upside would be more accretive than any shocks on the downside could damage.
Right. Talking about exchange stocks now, look at BSE rallied 10% today. Even CDSL had a rub-off impact, and we saw a positive close, right? We have a positive report that came in. I think that was the trigger for the rally. But, of course, it has been gaining market share, gaining share in the derivative segment, with its BankX products doing fairly well. It is posing a big or stiff challenge to NSE as well, right? But NSE recently had cut transaction charges, right? Both cash and derivative segment, although it was 1%. But do you think that could drive away some volumes, or do you think that the cut is too small to have any impact on volumes for BSE?
So a couple of things, the cut, of course, it is small, and I do not feel that it would have a direct and negative bearing on BSE itself, because BSE has a couple of things going for itself, separately. So, like you rightly said, the BankX product is something that is picking some very good pace and momentum. In fact, BSE has outlined a roadmap wherein it will focus on increasing its share in the derivatives volume and option volume segments as well, right? So considering where BSE is right now and the macro outlook on, let's say, capital markets, which is anyways in favor of exchanges right now, we believe BSE stands to gain far more from this point in time. Just quickly iterating: one, an increase in its options and derivatives volumes; two, an increase in its operating efficiency. So BSE as a company also is improving its operating efficiency and focused on its earnings. Three, we believe that all sectoral tailwinds will percolate and be more pronounced to BSE from here on. It is not exactly challenging NSE at this juncture, but it is building capabilities to do so at some point in the future, right? So even the lower base in terms of market share and in terms of participation that it enjoys, any delta or any change from here on would look slightly amplified and would really garner a lot of investor interest. So think of it slightly in terms of it being a low base effect also from this perspective, right? So BSE does have a couple of tailwinds, both at a macro, at a sector level, as well as at a company level, where a couple of stars are indeed aligning for its business and earnings prospects going ahead.
Right, for other exchange stocks like MCX and IEX, do you see, room for more upside? Because IEX on a YTD basis has, shaved off somewhere around 19%. MCX has been doing well, of course, although there was that issue of glitch that happened recently. We saw the stock reaction as well, but since then it has done well. I think it has kind of put it in the past. In fact, it has, kind of come out of it. So on these two stocks, MCX and IEX, any thoughts? For MCX, do you see any risks going forward?
So while these are exchanges, these are very distinct businesses also, right? MCX also has a few things going for itself. Of course, there are the macros of volume expansion, very primarily working in favor of MCX, and again the earnings growth that has been going in its favor. Sure, there are a couple of hiccups that came along its way so far, and the possibility of such events coming along is there out there for almost every company, right? It's the nature of the beast. Running a business, there are uncertainties that do keep coming up. However, at a from a bottom up perspective, MCX also seems very well positioned to ride the upcycle, in terms of increasing volumes and as a derivative of it, increased earnings growth expectations. On the other hand, IEX is in a very different segment of business. Although in the exchange business there are a few risks to it also. From time to time you see, this is a business where a different set of regulatory intervention has quite some role to play. We had the issue around decoupling that happened quite a while back, that that divided schools of thought at that point in time. Even going ahead, the role of IEX and its ability to maintain its positioning in the market going ahead against the backdrop of regulatory headwinds seems to pose quite a question mark. So, I feel IEX is something that one must look at very closely at a much more micro level. And of course, while macro tailwinds may be in favor, but a closer look at how the business model is working right now, and how is it exposed to regulatory challenges, and how has the regulation been shaping up in or against uh, IEX business model, is something that will offer a lot of perspectives for an investor to make a decision on IEX very specifically, and it should be viewed separately from how one would typically view a BSE or MCX as a business.
All right, that's an interesting point you made, Nirav. But I want to shift your focus to gold loan companies, right? We saw a good uptake in shares of Manappuram and Muthoot, given the fact that gold prices have hit a fresh high, right? But in terms of earnings, some of these companies saw gold AUMs also surge in excess of 20% in the quarter gone by, right? Of course, with this whole surge in gold prices, business will also be good for these two companies, right? So within the space, would you prefer a Manappuram or a Muthoot now?
So at this point in time, it's first important to understand what happened. It is in reaction to the FOMC dovishness that gold prices hit a high, record high, if I'm not wrong or mistaken, right? So what happens because of this is that the value of gold, that is typically a collateral in businesses like such of Manappuram and Muthoot, and especially where businesses are concentrated in the gold loan segment, the value of such collateral increases, which improves the asset quality. Typically, that's point number one. Two, the loan to value starts looking much better for potential borrowers. For the same amount of gold that someone holds, you will be able to draw on more credit while maintaining the same loan to value ratio, or in other words, while the company maintains a very similar margin of safety profile, right? So what we saw today was in reaction to the jump in gold prices. Of course, structurally, gold has been in an upcycle since quite some time now, and this has been aiding businesses of Manappuram and Muthoot. What's important to note is the segments that they're operating in, and the momentum of credit offtake that these two players are witnessing. I feel they are playing very distinct games in terms of business, although it may appear the same or similar at the very outset. Two businesses operating in regionally concentrated areas in the same segment of business, but their operating metrics are something that distinguishes one from another. So I feel one should take a closer look at business fundamentals such as the credit offtake and the momentum of credit offtake, and at the same time, their ability to improve their underwriting practices and expand their distribution networks. I feel these are the key business fundamental vectors that would finally go on to percolate and will be visible on the financial performance as well. So even here as well, the horses for courses, there are different things that work for different people, but at least these are the parameters that will help you very clearly distinguish what play is meant for what.
Right. So, how would you view Dmart now? Talking about the consumption space, that has not really taken off, so to say. But, Dmart has done well to hit a 5-month high today. CLSA initiating a buy call. But, in the last 1 year, it has done better than what it did in the year previous to that, right? So, do you see more runway for growth from here?
So there is indeed some runway for growth. There are a few expectations also that the street has from DMart. For instance, at the very top of the pack, we have expectations that the store count will increase significantly going ahead, as indicated by them. They're committed to increasing their presence. That's point number one. Point number two, we believe that its ability to improve its margins on the back of white labeled products will offer an earning tailwind to the company going ahead. So, while of course its operating costs are one of the lowest in the industry, that's something that's very well captured and resonated by the street. And its pricing power across branded products is also pretty good. One thing that has not come into full play yet is the margin accretion on account of its white labeled products, right? And the increasing share of their white label products as a part of their total SKUs, and as a share of their total top line, right? We believe this will also increase going ahead. So, together, a combination of these factors actually plot out and chart out a growth runway that seems really interesting and promising at the moment. Of course, the earnings growth so far has been slightly tepid. I mean, one would expect a whole lot more, but with geographic expansion and this margin accretive practices coming into play, we believe that we believe a complete earnings upgrade to be underway. From a slightly medium to longer term perspective, wherein we can witness growth right from the top line percolating into the margins and finally the PAT. So yes, from this perspective, it's interesting to view Avenue Supermarts, and one must take a look at it much closely from a medium to longer term perspective.
All right, DMart, looking good from a medium to long term perspective. But I want to talk about the bonus issue by TVS, right? It's a non-convertible, and I think something that preference shares which cannot be redeemed, really, right? So how does this really, bode for the shareholders? How would you read into this move?
So it's typically a good thing. It is not quite heard of generally, but the NCRPS, which is a non-convertible redeemable preference share issue of 1:4, is a good ratio. Basically, good news for shareholders. Either ways, I feel the company will be expending approximately what my estimate is around 2,000 odd crores. I feel it is in the range. I read something around the range. And apart from that, the company will not be really diluting its equity side, and at the same time not taking on a lot of debt to offer this. They will be servicing this through their reserves, is what they've indicated. So I feel it's a financially prudent move on the company side, and as a shareholder, any such issuance is definitely a positive as a as a shareholder, especially if you have been holding for the longer term and you indeed believe in the longer term prospects of the company. This comes in as a fresh whiff of good news.
Okay, thanks for putting into perspective what this really means for the shareholders. But another stock that's on my list today is NMDC. It has cut lumps and fine prices by somewhere around 250 rupees per ton. First such cut in the last 8 months. This was something that the street was already anticipating, right? Because I don't know, prices have fallen quite a bit. But impact wise, how are you reading into this?
So, this was in the making since quite some time. The iron ore prices globally have corrected by almost one fourth over the past, year or so. And, China has quite some role to play over there, because there's quite some stockpiling happening over there as a result of the real estate overhang, where a lot of such iron ore was actually consumed. And, all of that finally led to an oversupply sort of a situation and the decline in iron ore prices that we see today. However, such a slump in prices, we believe, may affect NMDC's earnings to quite some extent. Right. So of course, there's one thing that the export price parity was such that the domestic prices were trading at a premium. We believe that will that narrows significantly the disparity there in the export pricing versus domestic procurement prices. But this will also come at the cost of NMDC to some extent. So there could be some pressure on NMDC. Now, the extent of it may not be significant and not be immediate. However, in fact, if nothing, it would be only immediate and not extended, is what I meant to say.
Hmm.
So there will be some affecting. It will affect NMDC to some extent, but we don't believe that it will sustain and extend much longer, because now there's very little headroom for any more price adjustments, at least in the shorter term, and at least considering everything the way it is right now.
Lastly, I want to talk to you about the IT pack. The fact that Fed has decided to, dole out 3 rate cuts despite the fact that inflation is sticky and job market is still hot. That spells good news for IT names, right? Which have, of course, in recent times had seen quite a bit of selling. So, next few weeks or months, so to say, do you think we could see a good or another comeback by IT names?
Yes, indeed. The FOMC, the FOMC decision is very well aligned with the dreams that IT shareholders have right now. So it also sort of indicates a softer landing, sort of an expectation. Although the jury is still out on how soft is the soft landing going to be, but at least it is indicative that it's not going to be rough either, right? So we believe a lot of business confidence to emerge out there in global markets, and the demand for IT services to increase. So far, Indian IT companies have been really waiting for order wins and the ability to execute such orders. So there was also a situation where the orders have been coming through, but it is only just recorded as an order or as a contract, but there's a lead time between receiving an order and finally executing it. And to execute it, you also need the revenues to start flowing it on account of such contracts. So we were somewhere stuck in the middle. We believe as companies also globally start getting some visibility on the rate cut, and they start reacting to it positively in terms of firming up their IT expenditure budgets, and start releasing not just orders but also payments as orders start getting executed. The entire cash conversion cycle should start moving in favor of uh, these IT companies per se. So we believe that IT companies will start doing well, and of course at the same time there's also the currency tailwind that comes into the play going ahead. Especially for IT companies with a large exposure to global markets and to the dollar index.
Hmm. Well, that's the word then. Good times ahead for IT firms, hopefully, given the fact that we've had a dovish, so to say, commentary coming in from Fed. With that, Nirav, really appreciate your taking out time this afternoon and joining us and sharing your thoughts with us. Always a pleasure chatting with you, and I look forward to having more such chats with you in future.
Likewise.
Well, with that, we've come to the end of this edition of Closing Bell. It was a good day for the markets. We've ended above that 22,000 mark, just about a shade higher than that. But of course, it was the broader end of the markets, that staged a very good comeback with a 2.5% kind of gain. On that note, it's a good bye from me. And, thanks a lot from me and the entire team for tuning in this afternoon. Have a great evening, but come back and join in tomorrow morning at 9 a.m. with Opening Bell.